Many of us, you didn't start investing at all till you were in your 20s. Some people in their 30s, and some people have gotten to their 40s and 50s. They've not started investing. You were in medical school, you were studying. Meanwhile, maybe your buddy who worked in a bank or worked in an insurance company and started working at 24 might have also started investing. So it's a bit like we are playing catch up most times when most doctors start investing, doctors and healthcare professionals in general. Even though you've started late, you've got a little bit of an advantage. You might not be the highest earner in the community, but you're in the top 10%, you're in the top 5%. Even if your income was not a million or whatever, but for the fact that you have a decent income, I mean, we used to say guaranteed. It's not always guaranteed these days, but if you're a doctor and you're willing to work, because of that, you've got some relatively sensible income, so you can actually weaponize it to build assets, to invest. I'm Dr. Andy Gim. I'm the founder of Moneywise Doctor. A Moneywise Doctor is a platform that helps doctors and healthcare professionals make smarter financial decisions. Right. So what's my background? As from the name, when I say Dr. Andy Gim, it's not like Dr. Dre. I actually went to medical school like a proper doctor and did all that. And up till 3 years ago, I was working as a salaried GP. But prior to that, I started investing around late 18, more like 19 years of age. It got me to the point that by the time I turned roughly my mid-30s, I had achieved that level of financial freedom that allowed me to sort of decide to walk away from my salaried job. And it gave me that flexibility. A bit of my background, a Moneywise Doctor, I started it after I left my salaried job. I thought, oh, should I go into AI and do this stuff? ChatGPT Doctor.ai. But I'd always enjoyed teaching. I was that guy back in med school who would teach my consultants investing and run all those classes and all that stuff was on TV. So so I started blogging about Moneywise Doctor, some financial mistakes I was seeing colleagues making, things that they will usually call me and ask me about, especially those that have known me right back from med school. And the blog blew up. 2 years later, got a podcast, got a blog, and a channel and all that. I will do master classes like this. But yeah, so feel free. I want you to learn as much as possible in this master class. Because one thing we all understand as doctors now, we all know, you wouldn't be here if you didn't know that just working and saving money is not enough anymore. It's not enough for financial freedom. It's not enough for financial independence. It's not enough to get you to where you need to go. And some people say they will get NHS pension. NHS pension is great. I don't have it because I don't work for the NHS anymore. But also, many of us now know that many people don't want to wait till they are 68 or 71 or whatever the age might be. So that's why more people are trying to learn about investing, understand their options, understand how to manage money. I think that's wonderful. I think that's great. That's something we should all be focusing on, taking charge of our financial future and not just leaving it to chance or leaving it to, the government to take care of us. Right. Okay. So that's a bit about me. So I'm just going to, Chris, not to put you on the spot, but I'm going to ask, you've attended a master class previously. Could you share something? If there was something that you learned, could you share with us? Even if it's 1 point or something you are hoping to learn. I told you guys so it's going to be an interactive session. I'm not sure Chris can hear me. Right, okay. Is anyone here who has what are you hoping to learn? Anyone who is feeling up to it? It's not going to be a one-way discussion anyway. If you've joined the class and you were hoping to learn something, can you share what you are hoping to learn? Can you type it in the chat? Tax efficiency when doing locum GP jobs, isn't it? Okay, that's a good one. Okay, let's see who else. Tax efficiency is a big part of it. Because when you start investing without tax efficiency, it's like putting money in a leaking pocket. So tax efficiency is very crucial. Okay. There's a ML that said more about investing, SCIS, EIS. Okay. Favor said making better returns on investment. We're all about that. How to invest, alternatives to NHS pension, investment opportunities, pension options, emergency funds. I love that. So we've got quite, okay, someone said SIP. So everything you mentioned is actually core in what we sort of look at in the master class. We don't just talk about investing. We also look at investing from a tax efficient point. How do you make sure that you don't just make one, you make a pound, but the government ends up taking like 40% of it. And most of us know ISAs, but ISAs are only like the beginning. There are ISAs, there's SEIS, there's EIS. Obviously, there are things like investment bonds and trusts and the rest of it. But we're going to start. Basically, I'm going to teach from this class and then listen to your questions. And we're going to address whatever questions you have at the end. So I'm going to crack on now. And like I usually do, as I've done in previous classes, I'll ask, when you think about investing, can you tell me in one word what comes to your mind when you think about investing? What's the one word that comes to your mind when you think about investing? I've heard people say different things. I've heard people give different, ideas. But when you think about investing, what's the one word that comes to your mind? What does it make you feel? How does that make you feel when you think about investing? Okay. Right, Tona said good, and Mina said wealth. Dami said wealth. You said money. People are quite generally positive in this one. I've heard people in seminars where people say terror, terrifying, and all that. So if you think about investing, I love that you're speaking the language. That means you're not afraid. It's a positive thing. At the same time, it's like fire. Fire is a good servant, but it's a bad master. So knowing how to manage your risk, that's very good. Let me see, ROI, I like that. Becca said ROI, that was return on investment. When we said putting money to work, but Toby said something I really enjoy. He said risk and returns, and Priya said profit. Lovely. Right, so at least we have some general thinking or feeling around it, and it's quite surprisingly very positive. In the past, you get people think, oh, loss, fear, losing money and all of that could also happen as part of investing. But what we are doing today is sort of like removing the jargon when it comes to investing. Like I told you, I've done this for 20 years now. And I know there are people who say, like I was speaking to someone from London Institute of Banking and Finance, and they said, oh, I don't think if you're not a doctor, you shouldn't be removing your mole. So if you're not a professional, you shouldn't be investing. You should give it to the professional. Like, that's absolute rubbish, because 20 plus years I've been investing, managing my own money, learning about it, growing, my finances, and got to that point of, some people call it FU money, basically, but we don't want to be vulgar, do we? It basically, like, you can walk away from not needing to work and you're covered. I mean, that's one step. That's even before you get financial independence. But financial independence at that point where, look, even if you don't work for the rest of your life, if you maintain your lifestyle at the current lifestyle, you're going to be fine. Right, okay. So that's a little bit about, that's your feelings about investing. I'm just going to share a few things from the slide. But don't worry, we're not going to be stuck to the slide. It's not going to be dead by multiple PowerPoints. Right. So this is a little about me. I already talked about this, so we're not going to spend too much time on it. But you can follow me on social media, Moneywise Doctor, on Facebook, on X, that's me, and on Instagram. We have very interesting daily, like content on Instagram, as well as the YouTube channel every Sunday by 6 p.m. Sometimes it goes to 6:15. We publish a newsletter and also a podcast. So the newsletter and the podcast usually will teach you something new. Because basically, I know for doctors, we're all very busy. So nobody has time to be hanging around and just reading all the financial piece and everything. But if you have snippets, 5 minutes, giving you what you need to know, then that's usually quite helpful, isn't it? This is how to get financially smarter in just 5 minutes. Sometimes the difference between making smarter financial decisions and costly, horrible financial mistakes is having the right information at the right time for the right person. So every week I write the Moneywise Doctor weekly newsletter. It's an email newsletter packed full with valuable financial insights and updates to help you make smarter financial decisions and avoid costly mistakes. Some of the areas I've been covering over the last 70 weeks include actionable tips on tax strategies, pensions, investing, side hustles, and several other financial areas. Now, join thousands of medics who subscribe to the Moneywise Doctor Weekly newsletter to receive it straight to your inbox, and it's totally free. Don't miss out. Subscribe now using the link in the description. And now let's jump right back to the episode. Right, so that's what we do. We write this newsletter that is read by thousands of doctors and got like a podcast and a YouTube channel. And the goal there is helping doctors and healthcare professionals become financially smarter without having to get overwhelmed or confused or spend too much of their time chasing after charts and numbers and reading everything. So that's what Moneywise Doctor does. So the goal for the masterclass is basically to help you learn how to become a tax efficient investor, and in a way that you can do it passively or actively depending on your bandwidth. So I don't think we need to go too much into housekeeping. I know we're all doctors, healthcare professionals. We know the basics, like obviously we want to keep your mic mute except when you're speaking, and obviously if you want your camera on. I really appreciate seeing your faces, and also if I start speaking any jargon, if you look a bit confused and I'm looking at your face, I know I need to change my language or explain it a little bit better. Because basically the language of finance and the language of medicine, they're a little bit different. For instance, if I say PE, what comes to your mind as doctors? Is a different thing when I'm with the finance guys, and it's a different thing when I'm with doctors. If I say PE, can you write in the chat box what comes to your mind, what you think about? If I say PE, I just want to see just a little bit. We're just going to do a little bit of an exercise. I'll say some things. Confidence says pulmonary embolism. So yeah, I have the right people in the group. That means say pulmonary embolism. Mary said pulmonary embolism. So yeah, and okay, Joyce said physical exam. Someone that has a slightly different, but still the medical line. And James said physical exam. Yes, so but in finance and in stocks and basically in the stock market, P is price to earning ratio. Is a very basic, very common. I mean, last weekend on Saturday in our 4 weeks, so we have a 4 weeks investing academy for doctors, which is currently full. And I talked about PE, and everyone talked about pulmonary embolism. And I thought, really? But it's price to earning ratio, which is a multiple that you use to look at a stock to see whether it's overvalued or undervalued to start screening it. Okay, I'm going to give you another one, and I'd like to see what you say. For all those that have not participated in the chat, try to participate this time. PSA. Tell me the full meaning of PSA. This one is something very relevant to every one of us here, especially if you have money. I'm not going to say much because I might give away the answer. PSA. Confidence again says process-specific antigen, a real medic there. Okay, Dami says process-specific antigen. Okay, that's good. And Emmanuel has been to a seminar before, be honest. Said personal saving allowance. Well done. And Mary said prostate. So everyone says prostate-specific antigen, except Emmanuel, who says Emmanuel and Jimmy and Becca. All right, who said personal saving allowance. Okay, so Emmanuel has never been to a seminar. Emmanuel, I think I recognize your name. Do you read our emails, our weekly newsletters? Do you get it? Yes, you do. Okay. Either way, yeah. So that's what I'm trying to say. You see, the language of doctors, where like for us, PS is process-specific antigen. I was in a group with some sort of like financial advisors, because in Moneywise Doctor, we screen financial advisors and also get them on our platform if we need to recommend them, if they meet our criteria. And they said PSA, and I said that PSA means something different to me and to most doctors. Like what? It's personal savings allowance, but to them it's something different. So I'm sitting in the middle, bridging that gap. We're just going to do one last one before we then jump into the rest of the seminar. HRT. So what does that suggest to you? I know some of you might get this one, but HRT, give it a go. If you think as a doctor, you wake up and someone says HRT, what do you think about? Imelda said higher returns. Okay, that means it's true doctor, hormone replacement therapy. And confidence hormone replacement therapy, hormone replacement. higher return turnover. I appreciate some people trying to do different things. Now, if I give you a little clue, it's related to your taxes. So just like there's BRT, basic rate tax, and there's HRT. I like him out there trying to think outside the box. But it's higher rate tax. That's what you are on. That's what many senior doctors, if you're a GP, if you're a senior registrar, sometimes just even a trainee, a junior trainee, but is making a bit of money and low from property income or from dividends. So higher rate tax. Yes, Mary, higher rate tax. So basically, in the UK, there's 0% tax from any income from 0 to 12,570 is 0% tax. Well, if you're between 12,570 to 50,271 pounds, let's just say 50k, you're on 20%. So you are BRT, basic rate tax. But now when you cross from 50,271 up and you get to 150k now, so you're on higher rate tax, okay? And that in itself is 40%. Of course, 125, sorry. And of course, there's the additional rate tax, which is 45%. Now, it seems like that's the end of taxation, but there's still a lot more that comes with it. So basically, this is just to highlight how you're a doctor, you're a specialist here, you've been trained, or even you're still in training, and all your life, you've been in medicine all this while. But you have a second job which you didn't know about, which is being the chief financial officer of your life, managing your finances. It's not something you can delegate, I'm afraid. Even if you want to get a financial advisor, accountant, and all that, those are all good. And I also have advisors, I have accountants, I don't buy my insurance by myself, or my mortgage. But at the end of the day, you're still the one ultimately responsible for the financial well-being of yourself and your family. Is not something you can delegate. It seems a bit unfair, but that's life, isn't it? At the end of the day, it's something that even if you give it a little bit of attention, can give you a lot more return. Because I've come across doctors who just didn't realize that they were overpaying tax for 20 years, 30 years. I've come across doctors who fell into the 60% tax trap. They just knew that they were working hard and they were getting this income, and HMRC was writing to them that they were owing them. They didn't realize they've lost their personal tax allowance. And then there are other people who knew but didn't know what to do. And some of the painful one I've seen is senior doctors, hardworking doctors. I've spoken in conferences where people walk up to me and say, I've got £100,000. It's just in my account. I don't know what to do. And they're earning interest on it. And guess what? When their interest they earn crosses the PSA, remember PSA, personal savings allowance, they then have to pay the tax. Yeah, Shaun said they're in the same dilemma. Yeah, it's very common. It's very common. So a lot of times doctors are there and they're thinking, what do I do now? And there's no credible. You might see somebody on YouTube saying random stuff. A lot of those things don't apply to you as a doctor, and sometimes doesn't ever apply to you as a dentist or healthcare professional, more so when you're in the UK and you're thinking about getting credible financial education. It's really something that even if you spend 10 minutes per week or even 5 to 10 minutes per week on, you would be in a much better position. All right, so that's a little bit more about the goal of the masterclass. Now, what makes this different? I think we've already elucidated a lot of that. What makes this different from any other masterclass? Apart from being a doctor, I've been in the system, I've been able to sort of get to that point of basically walking away. I haven't walked away from medicine because obviously I love practicing medicine, but I also pick which 20 days in a year I can decide to practice the medicine to keep my license. But also that's not what makes it different alone. What makes it different is that I understand from the angle of doctors and I understand from the angle of finance. So this is tailored for healthcare professionals. I'll give you a practical example. For many of us, you didn't start investing at all till you were in your 20s. Some people in their 30s, and some people have gotten to their 40s and 50s. They've not started investing. You were in medical school, you were studying. Meanwhile, maybe your buddy who worked in a bank or worked in an insurance company and started working at 24 might have also started investing. So it's a bit like we are playing catch up most times when most doctors start investing, doctors and healthcare professionals in general, because you spend a lot of time in your training and you've not really had time to think about that aspect. Okay, so that's one thing to consider. Number two thing to consider is that even though you've started late, you've got a little bit of an advantage. Why? Because you might not be the highest earner in the community. Basically, if you come to UK, doctors are not the highest earners, but you're in the top 10%, you're in the top 5%. It might not feel like it, but that's what the data says. If you earn 65k and above, you're in the top 10%. In fact, when you're earning about 100k, you're moving up towards the 2%ers. So either way, even if your income was not a million or whatever, but for the fact that you have a decent income, I mean, we used to say guaranteed. It's not always guaranteed these days, but if you're a doctor and you're willing to work, there are still doctors who can't find work for many reasons, but they are in the minority compared to, let's say, people who studied finance that can't find work, or lawyers that can't find work as lawyers. Right. So because of that, you've got some relatively sensible income, so you can actually weaponize it to build assets, to invest, so that you can actually go from more of end income to more of asset income. Because unfortunately, I'm going to tell you, and see, I have to be frank with you, the tax code, which I've studied quite a bit. In fact, I've looked into the UK tax quite a bit. It seems to favor if you get your income from things like capital, like dividends or that type of income, it tends to have a lot of advantage and a lot of tax flexibility compared to just end income. But if you're working, you have to earn money. What can you do at this point? You have to start from somewhere, but you have to start that journey and do it efficiently and consistently to move your income, not just from end, to start getting things like dividends and income from other sources, basically. So these are the second thing to think about as a doctor or healthcare professional. One, you've started a little bit late. Two, even though you've started it a bit late, but you've got like decent income, you have life experience, you can actually accelerate. And what that means is that if other people are investing 10%, you should be thinking about 20%. If generic financial advice says 15% of your annual income should go into investment, you should be thinking, should I do 20 or 25? Basically, because you want to accelerate the journey and you want to make it an option that by the time you are hitting 55 or 60 is an option if you want to stay on and work till 68. And for those of you who even want to do it much earlier, that means you might have to do a little bit more aggressive in your asset allocation, which we are going to look at subsequently. Right. And again, the third thing I'll say that makes this seminar a little bit different, apart from my background and the fact that for doctors is quite specific to doctors, that the financial industry doesn't play by the same rules as medicine plays. So if Imelda, I know Imelda is a GP, if Imelda has handed me over like a patient, and whatever she says, I'll lean more towards trusting what she says about the patient. If she writes me a referral letter, I'll lean more towards believing that. In the financial industry, it's the other way around. It's trust but verify, because the same level of ethics is not the same. So unfortunately, when doctors go off and say, oh, I have this financial advisor and they said this and that, I'm like, who has used that financial advisor before? What are their qualifications, and what are the reviews? Basically, we tend to have a little bit more stringent when we look at advice or anything coming from the financial industry, because yes, there have been rules, and for the last couple of weeks I've been studying so many times the financial industry ripped people off, and then the rule came into being. And I had a maybe a former banker saying how they will put off the ATM machine so that people have to come into the banking hall, and then they'll try to sell them products. So the financial industry has always had those problems. Not everyone who works in the financial industry is a crook, but unfortunately, the standards of ethics is not quite the same. So doctors, when you're dealing with the financial industry, you need a little bit more labor to work out, okay, who am I dealing with here? That's part of what we do in Moneywise Doctor. It's sort of like screening those advisors and then saying, okay, we've verified this person. I think they're all right for life mortgage, life insurance, and advice and all that. So the financial industry, it seems to play by a certain different rule. I know someone saying to me that when he started out in mortgages, they used to have something they call doctor mortgages and doctor finance deals, that it was deals that other people would spot and say they weren't going to take. But most doctors were too didn't seem to notice. I thought that was a horrendous way to treat people who were actually out there trying to, make other people feel better. And that's part of the motivation for Moneywise Doctor. All right, enough of that. I'm sure you understand now what makes this different. Before I crack on, before we go into sort of like looking at things like tax optimization, because I think you should think about tax optimization before you start investing. Can I check in this place right now in the group? Is there anyone here who has actually done any sort of investing at all? I know some people have mentioned that they want to get better returns, invest better. Better returns is good. I mean, we got 87% last year, but remember, you can either eat well or sleep well. So if you could tell me in the chat box, what have you invested in? This could save you several thousands of pounds, not just in your taxes and pensions. Have you fallen into the 60% tax trap as a doctor or healthcare professional without even knowing? It's crazy. I know you think the highest tax you can pay is 45%, but here's how it works. If your income exceeds 100,000, you start to lose your personal tax allowance, and by the time you hit about 125,000, you've lost your entire tax allowance. This means you're paying an effective tax rate of 60%. That's not good. You lose a lot of other benefits with it. Now, if it's something you've never thought about or you're worried you're not sure how to navigate it, you're in luck, because I've written a very clear guide with a 10-point checklist that you can use to avoid the 60% tax trap. One of the biggest ones is obviously paying more into your pension, but there are 9 other steps you can take. Check the link in the description and download it for free. Let me know if it helps. Let's jump right back into the episode. You tell me in the chat box, what have you invested in? I want to understand so we know exactly what direction to go, because if you guys have all maxed out your ISA and you want to go into things like SEIS, EIS, sort of those kind of stuff. Let's see. We've got S&P 500. Someone said, okay. Who else? Oh, is that only Emmanuel that is actually investing here? Let's see. Okay, ISA, NHS pension, VTCA. Okay. So Jimmy said VTCA. Did you mean VCT? Okay. So you said I have minimal investing in managed portfolio. Okay. I've got an opinion about managed portfolios anyway, but we'll get into that. Stocks and shares, blessing. Okay, stocks and shares. Okay, that's good. So Vanguard, HL, okay. Agriculture, okay, that's good. S&P 500, the stocks and shares, pension. Don't know if you can call that investing or saving. Okay, I think we'll get into it. I want us to get into the nitty-gritty. I want you to walk away remembering exactly at least one useful thing that can help you. Okay. Then someone said different. Olu said different S&P 500, Netflix and others in trading 212. Okay. ISA. I'm invested in my money psychology. I love that. I think that's really important. Most people don't understand. We've had people, I think I had an investment banker, a former investment banker who is now a doctor, who, when she joined a Moneywise Doctor Mastermind, so she joined our private group and she had one-on-one coaching with me. And she said she was an investment banker for many years, but a lot of things she learned basically from our coaching was more about the money psychology and tax efficiency. It was not just about, just the money. And sometimes she just wants to chat, to discuss things, to discuss different options. It's not just about the investing itself. So that's a good one. I'm investing in my money psychology. Actually, I think this year I shipped 30 copies of The Psychology of Money, a book, to people in our Moneywise Doctor Mastermind, to 30 people, to get a copy of that book, because I thought it's very important. And yeah, Jimmy said VCT, so that's Venture Capital Trust. The one you can put up to 200K in a Venture Capital Trust and get up to 30% tax back as long as you hold it for 5 years. And Dami said stocks and shares, Nutmeg, Angela. So basically understanding the difference between the investment itself and the platform is really important. Cash ISA, okay, cash ISA is saving, but that's okay. You have to start from somewhere. Becca says stocks and shares, and James says Moneybox. Again, Moneybox is just a platform for investing. And the mail said EIS, but only once. Okay, that's really good actually. So EIS is a enterprise investment scheme. Is like UK allows you to invest in UK startups, they give you some, about cash back. In this instance is tax back. So they give you like you can get up to 30% tax back on your investment as long as you keep it there for a good you have to leave it there for a good 3 years for it to qualify. The maximum you can put in an EIS is £1 million. So you can put 20k in an ISA, but you can put up to £1 million. You can even go as high as £2 million in an EIS if it's a knowledge-based sort of like company, like a research company or something like that. So good. And I see LISA. Okay, yeah, LISA actually. You can actually use your LISA either for saving or investing. And Angela said ready-made investment with bank money box. Again, I'm not a big fan of ready-made investments, but I'm sure obviously you're going to pick what works for you. And I'll explain why in this seminar, why I think you may be better off doing it yourself, but passively. Basically, if you learn enough, even if you take out like 4 weeks or thereabout and learn enough how to do it, is a skill you take for life, and you can do what they are doing without paying the fees, because basically they are not taking more risk than you're going to be taking. Okay, so ISA, pensions, NHS, lovely. So we've got like a bit of a spread. I didn't see any real estate here actually. So real estate, not bad as an investment. I think you had agriculture, which was interesting. But in the last 20 years, even if you go back 50 years, looking at the data, but I looked at the last 20 years recently, there has never been any 5 years that any asset class beat inflation except one. Only one asset class has beat inflation. You know about inflation. I've talked about it a little bit. Inflation, basically, whatever you save in your cash now is not going to be what it will be worth in 10 years' time. Look, I gave an example that when I came to the UK, I had this £50 note. And that £50 note, what it can buy, or what it could buy in 2015, you're going to require £68, 5 cents, 5p to buy the same thing. So the value of, let's say, £100, then you now need like about £137 to buy the same thing. This is not something that you require an economist or an accountant to tell you. You probably have felt it yourself. You know the value of things, what it was a few years ago. So having money just in cash, it exposes it to inflation. Now, the point I was making about asset classes is that when you look at asset classes, when you look at cash, you look at fixed income assets like bonds and treasury bills and debt, all those type of things. Then you look at stocks and shares, which includes individual stocks, index funds, ETFs. And then you look at alternatives like real estate. You can even look at gold. There's been only one class of assets that has consistently, over the last 20 years, if you look at any 5-year period, only one class has beat inflation all the time. I mean, if you look at one year, none of the classes beat it because things go up and down. But if you look at any snapshot of any 5-year period, there has just been one asset class that has beat inflation consistently. Can someone tell me in the chat box again which asset class those are that I'm referring to? Okay, someone said property, close. Someone said real estate, close. Lesson said real estate, close. It's quite surprising. I'm getting like gold, real estate, stocks and shares. Okay, ETFs. Okay, REITs. Okay, so REITs is real estate investment trust. It's like real estate packaged, obviously, like in form of shares. Okay, right. Very good attempts. I'll tell you the answer, and you can check it up as well. There's a quilt I shared in our group. Stocks and shares, equity, over the last 20 years, even if you extend it back 30 years, if you look at any 5-year period, if you look at the average market indexes like S&P 500, yeah, okay, S&P 500, if you look at average market indexes like the FTSE All Shares Index, shares have beat the inflation. If you look at any 5-year period, look, as an investor, one thing I've learned in the past 20 years that's helped me is to not be sentimental about it. Look at the data, look at the numbers. It feels very warm. I would like to think, oh, if I buy a house, I'm just going to, I know like someone that was in our master class last year, the 4 weeks academy, investing academy, and he had this property. He had like 5-6 property, but at this point he was trying to now move from property to stocks because there's all these government rules, government changes, taxes, management issue. He's dealing with the 3 T's: tenants, termites, and what was the third T? Basically toilets. So that's a job. That's not like an investment. But even when you consider real estate as an investment, and consider stocks, consider cash, consider fixed income like bonds and treasury bills, stocks and shares beat inflation and then beat all these other classes if you consider them over a period of time. So when you are thinking about long-term investment, it seems like a no-brainer to me, not just because that was the asset class that got me to where I am, but because I've looked at the numbers. So is anyone shocked or surprised that it's stocks and not real estate? Because I saw a lot of real estate and gold, and basically I'll give you a quick number: S&P 500. So the top 500 companies in the James is surprised. The top 500 companies in the US, S&P 500 that you all know about, the index returned 25% last year. 25%. If you're a passive investor, you just put your money in the S&P 500 and did nothing. You weren't studying the market. You weren't following the news. S&P 500 returned 25%. Okay. Now, that doesn't happen every year, but if you check the average over the last 40, 50, 60 years, you'll be seeing return like 90-10%. And 90-10% compounding. Look, that is... Most times our mind cannot figure out what compounding can do, because by the time you go like a few years, it doubles. And all this while, you're not taking that much risk. So the issue is that most times we are going by sentiment and emotion and what someone said about something. But if you look at the data, you realize that at the end of the day, stocks and shares outperforms many classes. And now this is very different when you look at individual stocks. For instance, if you look at individual stocks, I'll give you an example with like Meta. That was one of our flagship individual stock in my portfolio. I think we've got like more than 200% return from Meta in the last couple of years, and that is one stock. Now, if you look at some other stock like Coinbase, we've gotten like more than 100%. But the issue here is not about individual stocks, because before I take those positions in individual stocks, obviously I know what I'm doing and I've done a bit of research. But if you're an average doctor, you're busy and you can't be bothered to go into the kind of like analysis and all that. Learning even the basics of how to do passive investing, to buy index funds, whether you want to go wide and buy global FTSE all shares, which is basically the top 7,000 companies in the world in terms of size, or you want to go a bit narrower and buy S&P 500, which limits you a little bit to the top 500 companies in the USA by capitalization, that's by size. Or basically, either way, you are buying into the market average, you are doing it passively, therefore you're not paying someone 1% or 2% management fee, which actually compounds and eats into your returns. And at the end of the day, you're going to come out much better than 90% of professional active investors working in the finance industry. You know, like finance industry guys who have studied all sorts of neuroscience, studied like rocket science, they studied finance, and they're working with computers. You're going to beat 90% of them because you're not going to be paying some crazy fees, and you're being tax efficient. You're not selling and buying all the time. So you actually find out that the data shows that when you go back even 8 years, the S&P 500 has outperformed 90% of professional money managers. Right. So at this point, I'm just going to pause before we go into a little bit more technical stuff, especially related to the UK setting in terms of tax. And I'm going to take a couple of questions. Maybe we'll take 3 questions, and then we'll go into tax efficiency as an investment strategy. We'll go and look at those 7 steps you need to take before you start investing. So I'll take a few questions now, and then we'll crack on. It seems we are stunned to realize that stocks actually do that well. Right. So I saw someone said, does this apply to Nigerian stocks? Actually, I found that because I started investing in Nigeria before I moved to the UK, and I've invested in about 3 or 4 countries now, I found that my Nigeria portfolio was giving me really returns that you can't imagine usually in the UK setting. but I had an issue with basically the currency, investing in local currency. I remember in 2020, thereabout, we returned 73%. I mean, we are picking up like at very low valuations, very low PE ratios. There were things like UBA. I think we got like 1 million units then. There was UCAP and quite a few of them. Obviously, any stocks I'm mentioning here is not for you to buy. This was like 5 years ago, so I don't know what they're doing now. I don't know your current situation. And we're getting like returns like 70-something% without any stress, even after adjusting for inflation and for the currency change. So it's not so much about where you invest in, about your education as an investor. I'll give you an example. Favor, I don't know, what's your specialty, Favor?
I qualify as a GP.
Right,
in August.
so excellent. So your specialty is family medicine, yeah, GP. Thank you, Favor.
Yeah.
Now imagine what happens if I bring a medical student and bring them to sit to your consulting room for 1 day to run your clinic. What do you think is going to happen?
Well, that may be chaos. To be frank, that may be chaos.
So chaos is actually really nice. I think it's going to be disastrous, basically, because it might look like, especially in the GP land, where it looks like, oh, this guy is fine, nothing is happening. Oh, you can go home. 3 months later, he's got bowel cancer. Nobody picked it up. Yeah, so the same thing applies to investing, right? If you haven't got the skill, there's a chance you could think, oh, the market is going really well. And then you just find out that, oh, suddenly when the market goes down, you find yourself in a very disastrous position. So Warren Buffett, who I look up to, and some of you know, I'm a fan of Warren Buffett, even up to the point of I'm a shareholder in his company, even up to the point of going to a shareholder meeting in Omaha. He says that when the tide goes out, you know who is swimming naked. And I don't know if you live in Cornwall. I train in Cornwall. If you live in Devon, like where I live, there are lots of beaches, and you can go and swim, or you might be surfing, you might be in the sea, and there's the tide, so nobody knows what's happening. But when the tide goes out, the water goes away, you see who has been swimming naked. So many people, when the market is bullish, so when the market is going up and it's going high, everyone says, oh, I must be a genius. I just put my money in the market and it's going up. But sadly, if the market turns down, like I experienced in 2008, we saw a lot of people swear off investing, which was a good time to be investing, basically, because the market crashed and you could buy some really good companies at discount to their net asset value. You could actually get some really good bargains on the value. But most people who didn't have the skill couldn't work out, was this a good idea or not? And even people who didn't have the skill but could have actually just bought the S&P 500 or a global index didn't do it at that point. So the skill is really important. And sometimes you don't need to become a professor of investing. Understanding the basics, and these things are not that difficult, is really important. All right, so I've got some questions coming to the chat, but I don't know, can the moderator, could you just let me know who's going next? Maybe we should, if you have got a question, just raise your hand in the queue so that I can join the queue, so we don't have to be reading everything in the chats. Okay, right, okay.
It's a question that so many people make mistake about, especially when you are investing in S&P, and you know it's a group sort of 500 top companies in America, and some of those companies are also listed individually, and you can buy their own stocks and shares as well. So he's asking me a very important question. So I just want to...
Okay, should we get him to ask then a little bit? What was the question?
Okay, the question is it wise to buy the S&P 500 and at the same time hold these individual stocks, which are also included in the S&Ps?
That's an excellent question. Thank you, Dr. Pepper. Thank you, Olivia. Why I'm smiling is because just on Saturday, in the third week of our investing academy, someone asked exactly this question, and they were doing it, and they didn't realize. Now, if you buy the S&P 500, so the question Olivia is asking is that, is it wise to, you already have S&P 500, which contains the top 500 companies in US by capitalization. So the top 500 just by size, not necessarily by profit, not necessarily by performance, but by size. Okay. So you have Tesla, you have Apple, you have Netflix, you have like so many, Coca-Cola. And she's asking, is it wise to, after I bought S&P 500, buy those individual stocks? Now, you could do that, but would that be advisable? What would you be trying to achieve? Because basically, the point of buying a global index fund was for diversification, to diversify. to reduce your risk. It's one of the top risk management approaches we teach in the academy. So that was the point of buying the S&P 500. So now going to buy individual stocks, you could do that because you could decide, okay, even though I've diversified my investment, but I still have, like, based on the research you've done, or because you use this product and you've decided that you want to take an extra concentration in Apple, for instance, then one could actually do that as long as they understand that that means that they are reducing their diversification. And I've seen people do this approach where they do 80% of their stocks or 90% of their stocks are in S&P 500, and then they have 10% which they just allocate to doing those type of investments. As long as you have a clear understanding of what you're doing and you understand that, okay, this is my risk management approach, then that's fine. But it's not something you should do randomly, because I've also seen doctors lose money because they heard that, oh, this stock is going up, and then they put in like maybe half of their investment portfolio in it, and then they lost money on it when the market goes down. So yes, you can decide to do that, but as long as it's your investment plan. Like in the 4th week of the Investing Academy, what we are doing is everyone writes out their investing plan, because it's the last week, which will be on Saturday. Everyone writes out their investing plan, and then that will be the plan they look at if they're making investment. It cannot be random, it cannot be by emotion, but it has to be goal-driven. You don't take more risk than you have to take, and at the same time, you don't take too little risk. Because if you take too little risk, you just have your money sitting in the bank account. Did that help, Dr. Lubumi?
Yes, it does. Thanks.
Lovely. Lovely. Right, Dr. Pepple, should we take the second one? Who's coming next?
So I've just summarized. 2 people are asking similar questions, prayer and blessing.
Lovely.
So I think they're asking about what brokerage you will advise, because someone asked about Moneybox, the other one asked about Trading 212, because these are all platforms you can use for investment. So if you just want to throw light on that, there's also Vanguard and all of that. So I know you'll talk about that. Thank you.
Thank you so much. That's a good summary. I am going to say this. I have a rule about platforms. I'm sure someone from my team will share a few links. I have a rule about platforms. I am not devoted to any platform. I mean, I've used different platforms. I've used about 4 or 5 platforms. Irrespective of whichever platform you want to use, and I'm going to mention some, you want any platform that has the least fees. Number one, that's the number one thing you want to check. And a platform that's easy to use. Okay? Has the least fees, easy to use. Has the least fees, easy to use. I did a video last year comparing the SIPs, self-invested personal pension. One of the SIPs was charging 0.45%, which seemed harmless. 0.45%. Until you think about your pension pot, which is supposed to be growing and accumulating, and your pension pot that is supposed to grow in, maybe it's getting to £1 million, somebody's charging 0.45% of that. Even 1% of, okay, if you want to work it out, say 1% of 1 million. So if you think about 100,000, so £10,000, I think that's it, 1% of 1 million. So you're paying £10,000. So 0.5% will be about £5,000. But this is money that can actually go into compounding to help your investments to grow. So when it comes to platforms, the big question to always ask is, what are their fees? Why am I paying more on this platform? So if someone is managing your fund, a lot of time they're not going to take the type of risk, calculated risk that I would take. Basically, if someone is managing your fund, and they would usually ask you, what is your risk appetite? And you say a medium. All the doctors, everyone I ask always says moderate. And so what was going to happen is that you're going to have like maybe a good 30-40% of your stocks of your money in bonds, depending on your age, and then maybe 60-70% in stocks, and then they will buy safe investments. Basically, they'll try to buy S&P 500. At the end of the day, you're paying the management fee and they are not outperforming. So if you're paying any extra fees, the question should always be, minus my fees, how much are you beating the market? Okay, because you're not doing it because you love them and you want to make sure that they make some money and wear nice seats. Okay. Someone said medium. Yeah, everybody you ask says their risk is moderate. I think in the group, in the investment group, we shared like how to check your risk tolerance, and most people found out that their risk tolerance was a little higher. Some people found they were medium. Unfortunately, the financial industry, most times they will treat you, that is a doctor, healthcare professional, the same way they will treat other people. Remember, I told you your case is a little bit different because you're starting a bit later. So what they will do is that they will think, okay, moderate risk, and they will now apply the rule they call 100 minus age. So if you're, let's say, 40 years, it will be 100 minus 40. So 60% of your money will be in stocks and 40% will be in bonds. So that means while stocks are growing, and let's say S&P 500 is returning 25%, bonds are returning 3%, and you're thinking, look, I've got another 30 years to invest. What am I doing with these bonds? Is that what you would usually do if you manage your money? So that's why it's really important to understand how to manage your own finances, your own investment, and even when you decide to pay extra fees, figure out what you're paying for, if it's worth it. But coming back to the platform, I would say look for a platform that provides you the services that you get elsewhere, but at little or no price. Okay, if you can get it zero, fine. If it's easy to use, better. And if you don't necessarily need a platform you can log into every day. You need something that you can set up automatically and send via basically direct debit, especially if you're a passive investor. Well, I hope you found that helpful. And more importantly, I hope it helped you to see investing in a new light. This is just a small section of what we cover in the full masterclass. If you'd like me to drop more of these clips, just let me in the comments. Comment invest and share this video as well with friends who may need to hear this. And if you are ready to stop winging it and guessing, guesswork is not good for investing. If you want to learn how to become a confident investor, to learn how to invest properly, check out our investing readiness scorecard with the links in the description. It will help you determine whether you're really ready to start investing and what you need to do before you even start thinking about investing to reduce the chances of you losing money. And until then, see you soon. Bye-bye.